Hey guys, this is Hamza. Welcome to the channel, and in today's video we're going to talk about something that you all know that I have a deep passion for, and that is real estate. In today's video we're going to talk about real estate investing and how real estate, just like any other business, requires a couple of things that are very important in order for real estate investing to be a successful venture for all of you. So in today's video I'm going to talk about the financial planning that goes behind purchasing a real estate investment or considering to purchase a real estate investment asset. Basically, you guys can look at it and call it like a real estate investment financial model 101 and things to look out for when buying or considering to buy real estate. But before we get into today's video, please consider hitting the subscribe button and hitting the like button for the YouTube algorithm, just so that it helps me out a little bit on YouTube. With that being said, let's get into the financial planning of real estate investment. Let's just call it the Real Estate Investing 101 course, right? So there's a few things that you need in order to have a successful real estate investment. And there's a few things that you need to consider before or as part of your due diligence, as part of your research into this topic. It is very important that you guys do the correct due diligence and the correct research on the market, on the asset class, and the actual asset itself, the actual piece of property that you guys are looking to invest in. Let's talk about the first thing you guys need to consider when financially planning to invest in real estate or a piece of property. The first thing that you guys need to consider is the mortgage. The mortgage is the payment that you make to the bank every month, and this can be amortized over 20 years, 25 years, 30 years, just depending on who your lender is. And you need to see how aggressive your LTV, your loan to values are, because some lenders will give you 80%, some lenders will give you 70%, some lenders will give you 60%. It just depends on a bunch of different things. So what type of real estate you're buying, who the lender is, how comfortable they are lending on these types of assets. And the mortgage payment is something that you need to put down in your financial planning to make sure that you guys are not only breaking even, but you guys are going to be able to pay that mortgage and have money left over for a few of the other things I'm going to cover in the video. The second thing you guys need to consider, which is additional to the mortgage, are the other expenses. So you're talking tax bills, insurance bills, and operational costs. Just like everything else, a real estate investment is an entire business in its own, and you guys need to make sure that you guys have all the expenses covered and then some. So you guys need to have your mortgage covered, you guys need to have your operational expenses, your taxes, your insurance, and just have a reserve in the property or in the bank account in order to make sure that this is a successful venture. Once all of those expenses, general expenses, are covered and you still have money left over, that goes into point number 3, which is your profits. You guys need to make sure that there is enough money left there for there to be good profits, which are generally like 5% all the way to like 9%, just depending on the real estate and the deal that you guys got. So if you guys are making 5 to 9% on cash flow on an annual basis, this should be a good investment. Some parts of the country, like let's say New York, 5% in mid-Manhattan is considered an amazing return, because some assets there actually trade at a negative cash flow return. What that means is these people are banking on something else or somewhere else to make their money. With that being said, let's go into the fourth thing you guys need to consider when financially planning for real estate. Now, in my previous videos, I talked about how rent bumps on an asset can increase the asset value in commercial real estate. And this is something that you need to consider. The fourth thing that I am talking about is appreciation. A lot of real estate investment around the nation right now is banking on appreciation and not on cash flow, which is kind of strange, but that is the way they operate. Just because the cash flows, people are not able to pay their rents, or the rents have not gone up significantly. However, the value of the asset has gone up. And usually there's a couple of contributing factors into this. A lot of institutional equity right now is chasing real estate a lot. And by institutional equity, I mean like higher up investors. So they're not the mom and pop investor. They're not individuals, but in fact companies who are looking to invest in real estate. And they have deeper pockets, and they want to put those pockets in. They want to put that money, in assets that are location. So they would buy something in mid-Manhattan in New York just because they know historically that those assets appreciate over time. and they're not too worried about the cash flows. I hope that point made some sense. Appreciation sometimes is a bigger bang than cash flow. Let's say, for example, you make 5 to 9% on cash flow. Sometimes appreciation can be 20% a year, just depending on where you're located and what part of the cycle you are in the market. I know it's very strange, but these are the times that we live in, where appreciation now is considered more important than cash flow, whereas in the past, people were more interested in cash flow all the time. The fifth and final thing you guys need to put into your financial planning when investing in real estate is your vacancy rates. Look at historic data on what the property's vacancy rates have been. So if you are buying or considering to buy a piece of real estate, ask for at least 3 years worth of information so you can track what the vacancy rates in those 3 years have been. You will also need to additionally look at assets around it, similar type products. So let's say, for example, if I'm buying an apartment community in the north of Houston, I'm going to go and look at least 5 or 6 other apartment communities and see what they have been performing at, just so that I get an idea as to what the vacancy rates in those areas are. And then I put that into my financial model and come up with a reasonable vacancy rate that I think is correct. Despite what the sellers will sometimes tell you, I still run those models all on my own just to make sure that we are covered as far as doing our research on this individual asset or piece of property. Now, if you add those 5 things into your financial planning when investing in real estate, you guys should have a very successful venture. If all the numbers make sense, you guys should definitely come out on top. That's it for me, guys. I hope you guys enjoyed today's video. I will see you guys next video.